Good evening, sir.
Good evening. How are we today?
Good evening, sir.
Good evening, sir. Okay, so this class is going to be short today. I think it's one of the shortest chapter. I'm very sure we cannot use up to an hour. So by 6, I'm targeting my time because of another engagement that I have to. By 6, to be done with this class. So let me quickly share the the link for the YouTube link for those of us that are unable to join through the Google Meet so that we can have access to the class. All right, so while we are doing that, today we want to talk about current issue. So sorry, I've not started recording. Okay, so let us begin. Like I said, today is going to be one of the shortest chapter, and we shall be looking at this current issue. So hopefully by Friday, inshallah, we'll finish with our syllabus, and I think we'll be having our meetings this week on how to prepare the timetable for the revision class. So, but before then, let us also prepare ourselves. So for those of us that are still new, some are still messaging me that they just want to join. So like this class is the well structure class. We have the summarized notes, and some they will just reach out to me. I will tell them this is the this thing for the summarized notes. They will just disappear. However, the material is just for you to help you read out on your course. Anyways, so let us begin. Today we'll start with current issue. Please do not let us disturb the class. For those of us that are found with that habit of not muting their mic, Dayo, please mute your mic. Anyways, so I've muted everybody. So like I said, this chapter is on current issues, things that's happened in the audit world, the ethical issues, what are the things we are expected to do, and the regulation that comes in after the issue has happened. What are the things that need to be incorporated? So let me take us back to some issue that happened in early 2001, the issue of Aaron Company and WorldCom, the Aaron scandal as a case study. The external auditor, which is Otto Anderson, collide with the shareholder and the top executive management of the organization to cover some substantial uh, evidence, some material issues in the company's financial statement. So they now also collide with the auditor to make the financial statement, to address the financial statement. They also increase the shareholders' earnings. so that to appear that the company is making a lot of profit, whereas they are not making profit. So early 2001, the company collapsed and it led to shutdown of the company, and the impact of that company is felt in the whole United States. About almost 4,000 workers were discharged, and there comes Sabanoste Law Act 2002, whereby it's strengthening more. They now bring some regulation that guides an auditor, what an auditor should do. That was where they actually said that it's going to be an ethical issue and a threat to professional independence for an auditor to also serve as a consulting to a firm where he or she is auditing. So a lot of laws now comes into play, and and up to today we are still using all those laws and regulation that's happened and as emergence to tackle the ethical issue involving the audit environment. So that is what we want to talk about today, and we will also talk about transnational audit. Transactional audit is that audit of financial statements of a company probably in the United States, but we want to use the report of that financial statement here in Nigeria, maybe to serve as to secure a loan from bank or another source of finance to the company. So here we shall also establish what transnational audit is all about, and the audit of small company. What are the things we need to put in place as an auditor when we want to audit a small firm? So that's what we want to discuss about today. So, like I said, I'm timing myself before 6 or by 6. You should finish this class. So, if you are just joining for the first time, this is the Advanced Audit and Assurance class, and my name is Olatunji Idris. So let us begin. Like our normal routine, what we used to do, we go through the content, the ethical issues, the accountancy and audit profession, the transnational audit, the small company, the audit of small company, then the impact of social and environmental matters and statutory audit, and social and also environmental reports and audit, development in emergency technology, company and matter Act 2020, and chapter review. So that's what we want to talk about today. So at the end of this chapter, let's quickly run through the exam context. As the student progress into more senior position within their firms, it becomes even more important for them to keep abreast of current affairs in the audit and assurance industries. Then this chapter summarizes a number of key current affairs. There is also a section that deals with social and environmental audit and assurance, another growing market for practitioners. At the end of this chapter, readers, everybody, should be able to discuss the current affairs impact in audit and assurance industry. You need to describe the demand for social and environmental reporting, summarize, summarize what is involved in social and environmental audit, briefly explain developments in emergency technologies, explain the current issue and exposure of draft interpolation, and also explain emergency technology relevant to auditing profession. This is the exam context, and after this chapter, you should be able to give answers to this highlighted question. So let us begin. The introduction. Like I said, this chapter just focused on the things that happened in the past years that makes things that happen in the audit environment or audit community that enhance us or make us to pick tight and bring one or two laws that will strengthen the professions and also the engagement as a whole. So that is what we want to discuss under this chapter. Please confirm if you can hear me on the app playing with the class, please. All right. So let us begin. We said these are issues that influence the behavior of auditor when carrying out their responsibility. So regulation of auditing. We have two regulations that we follow. We have rule-based approach and principle-based approach. So it is not new to us. When something is rule-based approach, those are the rules and regulations that has to be followed in doing our or in discharging our responsibility as an auditor on any engagement. That the step by step, the rules that has to be followed from the regulatory framework to standard setting. Those are the rules that we need to follow while discharging our responsibility. Those are rule-based approach. While principle or framework approach, it is that principle that govern. Principle is different from rules. Rules is, let me say, law that governs the that governs the profession, while principle are step-by-step way of discharging our responsibility. So in actual more sense, principle-based approach is more virtual than rule-based approach, because rule-based approach is cruel, is like you have to follow it on discharging your responsibility. While uh, principle-based approach has to do with your own discretion and also to follow a particular principle in discharging your responsibility. So that is principle-based approach. So let us see the what we have under rule-based approach and principle-based approach. So rule-based approach, this sets out the rules about what must and what must not be done. That is rule-based approach. While principle-based approach, this sets out principle that governs behaviors with reasonable argument to support the principles. So, however, the rule-based approach may not deal with all peculiar cases and may be interpreted narrowly. So, what we are saying in essence that in rule-based approach, what's this? Okay. Okay. So rule-based approach and principle-based approach have been explained. So, however, the principle-based approach is generally an adopted approach to the auditors or accountant, as rule-based may not deal with all peculiar cases and may be interpreted narrowly. So that is all about the regulation of auditing on rule-based approach and principle-based approach. So, what is auditors independence? This is not the first time we learn about auditors independence. And independence of an auditor is our ability to carry out our professional responsibility objectively. When some objectivity is one of the ethical codes that guide the conduct of the professionals. Objectivity is your ability to discharge your responsibility without fear of being biased. You have to say it the way it is. So our independence, which is the same thing as independence. When we are talking about objectivity, we are talking about our ability to do our work without fear of being influenced by anyone around us. That is what we call auditors independence. So, however, auditors independence is fundamental to the credibility of audit process. Much of current thinking on auditors independence was developed by SEC in US. This is 2001 and 2002 due to Aaron and WorldCom scandal. This scandal led to adoption of Sarbanes-Oxley law. Those are the laws that I talked about the other time, that after the collapse of Aaron company and WorldCom, so they quickly come together and bring this Sarbanes-Oxley law to strengthen more auditors' independence and to serve as guidelines or safeguard to auditors' independence. And what are these laws all about? There are those principles or these rules that we have to follow, that to enhance more auditors' independence in discharging his responsibility. So that's what Sarbanes-Oxley Law Act 2002 is here to deal with, strictly to strengthen more of auditors' what independence in discharging their responsibility. So let us go. Non-audit services that might impair firms' independence. So we talked about that because of the issue of Enron company. For those of us that have been following or that have read the story before, the Enron company, the auditors independence is not actually guarantee because the auditor is being influenced. They have to buy out the auditor to dance to their tunes. So that is why the auditor was unable to discharge his professional responsibility, thereby impair his independence. So, however, according to Tabanero Law Act, after the Iron Company issues in 2001, so there comes Tabanero Law Act in 2002 to strengthen auditors' independence and also give us guidelines on services that might impair auditors' independence. That is, those services that if auditor has engaged into it, their independence is not guaranteed. So having to list out all these things is going to probably now make the auditor to be aware of those activities and also reject the reject the offer if that particular engagement is being offered to the auditor because it's going to what impair their what independence. So please confirm it if you are hearing me, please. All right. If you have a question, please raise up your hand. And I'm not going to take more questions today because by 6 o'clock, I'm ending this class. So if you have a question, please quickly put up your hand and ask. Okay, so let us go. Transnational Law Act listed 9 non-audit services that might impair firm independence if they are provided to audit clients by firm. Number one, internal audit outsourcing services. What we discussed in chapter 13, the internal audit outsourcing services, that if audit firm or auditor engage in that non-audit assurance services, it can impair auditors' independence. The reason why we listed out all these services is for the auditor to be aware that these services, if engaged by the auditor or audit firm, is going to impair their independence in accordance with what with Tabanero Law Act 2002. So let us go. Number two is management function and human resources to serve as management function or to serve as the human resources in recruiting staff for your client. It will also impair the auditor's what independent. Number three, investment advisor or investment banking services. To offer investment banking services to the client can also impair what auditors independent. Legal services, expert services unrelated to audit. They said expert services unrelated to audit is also one of the non-audit services that can impair auditors independent. Actuarial services, e.g. valuation of pension services. Actuarial services can be you are helping them to value their properties or pension services or VAT services or any other services that have to do with valuation of some figures. It is actuarial services, and if firms or auditor involved in that particular uh, non-audit assurance services, it can pay their independence. The next one is financial information system design. To help them design the financial system design will also impair auditors' independence. Bookkeeping related to accounting record of the audit client. That is to help to involve in external audit of the organization, also to also be their in-house accountants or on record keeping can also impair the auditor's independence. Valuation services, generous opinions, or contribution in kind record can also impair auditors' independence in accordance with Tabanero Law Act 2002. Please confirm if you can hear me, please. Can I proceed, everybody? All right. So, have you truly understand that? And in accordance with Tabanero Law, then we need to now go to the advantages and the disadvantages of non-providing audit services. So, what are the advantages? So, advantage and disadvantage of auditor providing non-audit services. It's not that it is not good to provide non-audit services to your client, but you must not be their external auditor. Being their external auditor and you still provide non-audit services can impair your independence. So that is what the law is all about that. You cannot do this and also do this because it's going to probably impair your independence, and you are not going to discharge your responsibility. Your objectivity will be threatened. So that is the issues of all those services we read out ourselves, and the aspect of subalternously law in relation to Aerial Company and WorldCom standard in 2001 and 2002 respectively. So let's go to the advantages. Number one, the advantages, the accounting firm is an excellent position to provide its client with non-audit services. This is because one, it already have extensive knowledge of the client. So we said that the advantages of you doing being an external auditor and also provide non-audit service to your client. Number one, you will not stress yourself in you get to know uh, the environment of the client and the kind of business the client also involved with. So being an external auditor and also provide non-audit services, it gives you an edge to know or to know more, to have extensive knowledge about the client business and their uh, system of operations. And number two, it's therefore be able to provide additional non-audit service to the client at lower cost. Then you can also, it also helps the client to reduce costs because you are providing external audit service for them and also providing non-audit service assurance for them. So you can just use in your benevolent hand that, oh, let me just reduce this cost for you. Maybe non-audit services, maybe you normally charge 100K, and because you are external auditor to them, and they also want to give you this engagement, so they can tell you that, oh, pay 50K or pay 60K. So it's also serve as cost reduction to the client, and because you reduce service fee for them because you are already their external auditor. So these are among other advantages of being providing non-audit services to your clients when you are already the external auditor. So please, I hope you are following everybody. Please, can I proceed, please? All right. So let's quickly go to the disadvantages. What are the disadvantages? However, there are some obvious disadvantages to providing non-audit services. One, the accounting firm may be seen by the world at large to lack of independence from the client. So that's the disadvantages, and that is where the issue of error complaints comes to play, because that's the issue of where the error complaint comes to play, because the auditor is the external auditor and also provide non-audit services to them. So there will be lack of professional independence from the client to the auditor. The auditor will not be able to do what he or she is supposed to do, discharge his professional responsibility because of what? Because of that particular engagement. So that's one of the disadvantages. The accounting firm may be seen as may be seen by the world at large to lack independence from the client because of the large fee it receives from the audit and non-audit work. This was a criticism leveled at Austin office of accounting firm of Otto Anderson. Otto Anderson is the external auditor of what? Of Aerial Company back then in United States, Texas. So that is that about that number one. Number two, accountants from accounting firm may find themselves in position where they are making management decision. This, of course, will lead to self review threats because being an external auditor and you also engage in maybe accounting or bookkeeping records for the organization, you might end up being uh, among the people that take decision uh, on that particular situation. So thereby it becomes self-review threat to you. So these are among other disadvantages of a firm or an external auditor or an auditor providing non-audit services to a client where you are already an external auditor. So despite all these things that we have established, what are the safeguards? Don't forget in our chapter 3, yes, when we discuss about all these threats, we talk about safeguard. And one of the safeguard is rotation, audit rotation. The audit rotation is a situation whereby it allows the audit firm or the audit partner or the partner in charge to be rotated in order to safeguard their what? Their independence. Because if you are too familiar with the client case and you've been auditing the client account for over years, you will not be your independence will not be guaranteed because you'll have no one or two people that can influence your decision no matter how. So that is one of the safeguard to just the professional independence that you have to be. There must be what audit rotation. So this one will now bring us to the meaning of audit rotation and the types of audit rotation. Please confirm if you can hear me, please, everybody. Please confirm if you can hear me. Can I proceed, please? All right. So what is audit rotation? Like I said, is that uh, a safeguard that is established by the profession to to serve as safeguard to protect professional independence. If an organization or a firm has been auditing an organization for a very, very long time, their independence cannot be guaranteed. So therefore, the professional comes with this safeguard that can help an auditor to safeguard their independence in discharging their responsibility to their clients. I will call it audit rotation. So let us go. It has been suggested that there should be a regular change in the individual who perform the audit of a client company. This should prevent the auditor from becoming too familiar with clients and key member of the client staff. So what are the forms of rotation? We have audit partner rotation and audit firm rotation. Audit partner rotation. Let's assume there are 5 partners in this organization, myself and some others. So the audit partner rotation is maybe I'm the one that have been I'm the one that have been handling the company financial statement or auditing the financial statement for the past 7 years. So audit partner rotation is me being replaced by another partner in that particular department to handle that same job that I've been handling before. That is audit partner rotation. Like I said again, I am audit partner, then maybe Mr. Odrak is another audit partner, Chidima is another audit partner, and I've been the one auditing company ABC for the past 7 years. So they will take the engagement from me and give it to Chidima to handle being another audit partner in the same department. So yeah, because I've been auditing the company for the past 7 years, my independence cannot be guaranteed again because I will be too familiar with some key member of the client staff in the organization. So in order to safeguard that my independence in discharging my responsibility, thereby the engagement is being taken away from me and handed over to what to another partner, which is Chidima, to also handle the same particular what the particular engagement to reduce what to serve as safeguard to auditors independence. That is that about audit partner rotation. While audit firm rotation is taking the engagement from that audit firm completely. This is an example. Where I was working before, we happened to audit one of the Lagos State parastatal account, and the audit tenure is 3 years. So after 3 years, they will take the engagements from my company and hand it over to another company. That is uh, audit firm rotation, because they don't want you to be too familiar with the client staff in that ministry. So after 3 years of audit, they will take the engagement from our audit firm and give it to another audit firm. Then our audit firm will also be lobbying or try and submit proposal again for another ministry that is different from the one that we audited before. So that is another example of audit firm rotation. Please, do we understand these two examples that I cited before we proceed? Do we understand everybody? Hello? All right. So let us proceed. Now let's read what we have. Now, audit firm rotation. Here, the accounting firm may remain as auditor of the same client of the company for unlimited years until the company decides to change the auditor. However, the engagement partner and the key member of the audit team should be what rotated regularly. That is that for audit partner rotation. Now, audit firm rotation. Alternatively, the auditor should not remain indefinitely as auditor, as it is suggested that auditor are to be what change around 5 to 7 years. But this will require legislative amendment as the law provides auditor appointment for 1 year. Renewable what indefinitely. Argument has also been put out about the about for and against accounting firm rotation. So all what we are saying here is that one of the things to safeguard auditors' independence is audit rotation. However, the rotation can either be audit partner rotation or audit firm rotation. So after uh, and this one is going along with uh, the current issue that's been happening in audit environment. So, however, let us proceed. After we have discussed the ethical issue, the rule-based and principle-based approach, the non non-audit service assurance established by what by Terminology Law Act 2002, and also safeguards to auditors' independence. So, what are the audit? How does audit of small entity looks like, and what are the approaches that audit firm need to put in place when you want to audit what small entity? So let us go. That is what we want to discuss now. So after this, we go to transnational audit. Then we that is where the class will end for today. So let us proceed. Audit as a phase has the same meaning whether for large or small entity. The auditor is expected to express its opinion, which is normal. However, the audit process may differ significantly. The entity size is a key features of an entity. The entity size is the key features of an entity that has significant impact on the audit approach. Smaller entity may require a very different approach from large entity. What we are saying is that small entity, a small organization that want to audit, they will definitely are going to give audit opinion, but the approaches will be different from us auditing what a very large entity. So, however, these are the approaches for auditing a smaller entity. That is what we want to discuss about, and that's the basis of this argument now, discussion. So let us go. The following are the additional points that will be considered in small entities audit. Number one, acceptance of audit appointment is the same thing as what we have been discussed before, that audit firms should consider to uh, to accept or continue acceptance of an engagement that he or she have ability to execute and what to deliver on time. So, but those are this approach that we need to put in mind as an audit firm or as an auditor when we want to audit small entity. Number one, acceptance of audit engagement. The auditor should consider the risk of independence arising from close involvement with management pressure to reduce audit fee. One of the things we need to put in place that small audit firm, small entities that want to audit, they don't always have that, they cannot pay the normal amount of audit fee that we used to what, that we used to collect for a very big entity. So we need to consider the amount, the audit fee, because it's always a pressure and the risk of independence arises from close involvement with management pressure to reduce what audit fee. Because they will tell you that we cannot pay. Maybe you used to charge 10 million. You go, we cannot pay 10 million. Let us pay 1 million. So we need to consider the risk of independence arising from close involvement in what in manage with management pressure to reduce what audit fee. So these are the approaches that we need to put in mind as an auditor when we want to audit small entities. So let us go. Number two, engagement letter. This letter should include separation of account preparation function from audit function. So we also need to bear in mind that in our engagement letter, we need to clearly tell them, because they are smart, they have this intention or they have this mindset that, oh, it is this audit firm that will prepare the financial statement for them and they will still audit. So which is clearly against ethical code of an auditor. You cannot prepare financial statement and also audit the same account. So in your engagement letter, you need to also consider and state clearly that it is the company or the management of the organization that is responsible for preparation of financial statements. Why the auditor will audit the financial statement. So the engagement letter also need to be considered that control risk. The auditor may also be able to rely on the control space as a result of control risk likely to be high because the organization is small. So there are some things that they are not properly put in place, which can also trigger the risk of material misstatement. So the auditors should also put in mind that there will be likely to be high risk in the organization. So auditor need to consider a necessary measure to control the risk because they are small entity. Of course, most of their things will not be guided by uh, professional framework that need to be followed in preparing or discharging their business activities. So another thing that auditor need to also put in place is substantive procedures. Substantive procedure in this sense that because they are small audit firm, they are small entity and most of their things will not be put in appropriate place. So auditor need to put in mind that they need to do more substantive procedures. Substantive procedures by doing in-depth by conducting in-depth procedure in gathering substantial evidence in order to reach their conclusion or in order to reach their opinion whether the financial statement is of transfer value or not. That is all about substantive procedure. Their audit evidence. High quality evidence may be more different to find. High quality evidence because most of those evidences that you will be able to you should be able to gather and follow and form your opinion whether the financial statement is of transfer due. In the case of a very big entity, will be different from this small entity. So high quality evidence may be what may be different to find because they are small entity, they don't do much transaction. So the quality of high evidences that that you use to produce in determine your or informing your opinion on the said financial statements. In this case of small entity, will not be like that. So auditors also need to what consider the audit evidence in auditing what small entity as one of the approaches they need to follow. Another one is materiality. What does materiality say here? A smaller entity profit before tax may be consistently negligible as the bulk of any profit may be taken out of owners managers as what remuneration. So because most of small entities they are one man's business, so they are always not consider profit before tax and they always negligible of that particular area. So because most of their transaction might even be taken from the owner's purse that maybe I need this transaction or we don't have much money to go or to handle business activities. The owner can just transfer from his personal account to company as account without taking proper description or proper narrations as regard to that particular fund that have been transferred to the company's account. So all these things becomes issues and they are the things that the auditor need to put in place why they want to audit what small entity because most of the transactions are not clearly stated whether it is owner's contribution to the business or they just take everything as inflows to the business whereby they did not take note of profit before tax. So lastly, what auditor also need to consider in auditing small entity is the audit report. So what does this say? There must be insufficient evidence as to completeness and accuracy of record, which may lead to qualified audit opinion. So most of the opinion that used to be given is what is a qualified audit opinion because there's always a material misstatement and limitation of scope. Although it does not affect the entire area of the financial statement, that is what make it to be what qualified audit opinion. But most importantly, most of the audit reports of small entities used to be what qualified audit opinion because they lack what sufficient evidence as to completeness and accuracy of the what of the record in that particular organization. So all these are among other are the things that we need to consider as an auditor when we want to audit small entity. Please, everybody, are we following? Please, can I proceed, please? All right. So everything understand that we have indirectly moved away from uh, current issue. We are now going to the current structure of audit profession in Nigeria. What are the structure? We have Big Four. Everybody, most of us now, our dream is to work with Big Four, maybe KPMG, EY, PwC, or Deloitte. So here we'll be able to know the structure of audit firm in the world or in Nigeria as case. Let's use Nigeria as case study and their capacities. So let us go. Current structure of auditing profession. Because of increasing globalization of companies, auditing profession now has three tiers. Number one, we have Big Four, which is international company. The Big Four, they are international company. They are not Nigerian company, but they domicile or they have branch in Nigeria here. So Big Four, which is international firm, we have Deloitte, we have E&Y, KPMG, and PwC, which is PricewaterhouseCoopers. So that is the Big Four, which is number one. This thing. Then the second tier is small firm, but with numerous offices and international resources, which is another firm. So example of this thing, maybe we have all these SIO, Piston Pedabo, or Mazdas or so. So these are small second tiers that they have numerous services across the country, and they have international resources. Maybe they are using all this software as case may be. Then they have the small firms. These are those small audit firms in Nigeria. So let us go. The Big Four came about from foreign mergers and takeover within the professions. They have the resources, expertise, and geographical coverage to be able to audit the largest global entities. However, this level of amalgamation has left little choice for largest clients and the little competition for those large accounting firms. So, incorporation and problems of auditors' liability. Incorporation and problems of auditors' liability. So let us go. In recent countries, accountancy and auditing practice were originally established as a sole practitioner. What we are saying in essence that all these audit firm, these accountancy service, they are always there. Most of them are being operated by sole proprietorship or sole practitioner, like someone or like me, for example, maybe uh, uh, or individual person, like a sole proprietorship before they now becomes what it is today. So that is what we are saying in essence that in most countries, accountancy and audit practice were originally established as a sole practitioner, were permitted by law or partnership. With this business structure, sole practitioner and partnership, the owner or the owner have unlimited liability for the liabilities of the what of the practice. However, this will include liability arising from legal claims against the firm for negligence of audit work, the owner's personal assets as well as business assets at risk if firm itself cannot pay claims against against it. So what we are saying is that originally all these accounting firm and all these firm, they are mostly sole practitioners before, but in emergence of the globalization, the as the practice as the practice and the incessant uh, needing for accounting profession or audit profession. So most of the company or most of the individuals are now merging together. Maybe I'm an auditor, Mr. B is an auditor. Let's merge together and form a partnership. That is where all these big four also comes to play. I'm sure that KPMG you are seeing is four names like that are joined together. Maybe uh, four different persons to form a partnership and deliver accounting or auditing services. So, however, they are now saying that in the case of all these things, uh, the the uh, the the asset of the practitioners are also at risk. The assets, their belongings, their whatever that is accrued or owes to the practitioners are also at risk. If, for example, they are unable to to pay the claim laid against them as a result of negligence of work. So they are saying in essence that the liability, that is the liability from negligence of work can also be extended to their properties, or all their belongings can also be can also be liable to pay to pay as negligence if they are unable to pay claim laid against them. What we are saying in essence that you see their properties and their assets can also be liable to be used to be used as compensation in the case of in the case of any auditor's liability. So that is that about incorporation and the problems of auditors liability. So finally, we are going to transnational audit. It's not transactional, it's a mistake. If you check the content we read to ourselves from the beginning, it is transnational. So it was a mistake here while I was typing. It is transnational audit. Like I've explained before, what is transnational audit? This transnational audit, it is audit of financial statements of a company, whereby the report of that financial statement will be relied upon in another company and in another country to make for decision making. For example, a company resides here in Nigeria, so and probably they have branch, or there's another person or another company in abroad that need the report of this company here in Nigeria to serve as maybe gather loans, or maybe they want to use it for economic decision and they have their own business. So they can take audit reports here and the financial statement of the company here in Nigeria and use it as as their point of decision in another company in abroad. That is what we call transnational audit. Please, I hope we understand that simple uh, examples before we now dive into the meaning of transnational audit. Can I proceed, please? All right. So let us go. A transnational audit is an audit of financial statements which are or may be relied upon outside the audited entity home jurisdiction for purpose of significant lending, investment, or regulatory decision. This will include audit of all financial statements of company with listed equities or debt and other public interest company, which attract particular public attention due to size, products, or services rendered. So what we are saying is that another company in another country can use the financial statement or auditors financial statement of a company here in Nigeria, can use it in another company in abroad for the purpose of significant lending, investment, or regulatory decision in their country there. So that is what we call transnational audit. Any financial statement in Nigeria that is being used in another country in abroad for their significant lending, investments, or regulatory decision is what we call transnational audit. So let us go and let us proceed. So IFAC, Transnational Audit Committee. What is IFAC? That is International Federation of Accountants on Transnational Audit Committee. Tax. What are the responsibility or illustration of transnational audit? So let us go. So I want to give us an example of transnational audit on example 1 and 2. Let us go. For example, US company raising debt finance in Canada. US company, that is a company in US raising debt finance in Canada. That is, we are company here in Nigeria or in US, for example, and we want to secure loan in a company from a company in Canada. That's what they call a US company raising debt finance. Debt finance, that is, we want to secure loan. It's different from equity finance. I'm sure we all know equity finance is you getting finance maybe from a friend or as your another income from you that you can inject into your business. While debt finance is majorly borrow loan from another company or another source of fund, or maybe from bank to finance your business. That's what we call debt finance. So example of transnational audit here. So now said US company are raising debt finance in Canada. This will qualify as transnational audit, as it is reasonable to assume that provider of debt finance in Canada will use financial statement of the company prepared and audited by American standard in making decision. So that is where transnational audit comes in. That is a company in US that want to uh, secure loan from a company in in Canada. So the company in Canada that want to give US company loan will have used the audited financial statement of that company in US, the audited financial statement, the auditor's report, and their regulations to. They will have used the report in order to decide whether they want to give the US company loan or not. So in using that financial statement, prepare in US to for their own decision whether to give the US company loan or not, it becomes transnational audit. Please, do we understand, everybody? Do we understand on that particular one? Okay. So let's go to the example two. International charity taking donations through various national branches and making grants around the world. This will qualify transnational audits as it operates across national boundaries and of public interest, being charity. This is a reasonable expectation that the financial statement of charity will be used by someone, perhaps donor, in country other than the country it domicile. This is what we are seeing for this example too. A charity organization or charitable organization that operate across the country. Maybe they now need a donor, someone that wants to sponsor their their charity organization. Maybe the charity organization is in Nigeria, yeah, but they used to give charity to all charitable organizations maybe around the world. So maybe in the case that they now need a donor or a sponsor, someone that wants to sponsor them, the person will have used uh, the financial statement of that charitable organization prepared in Nigeria. Maybe the company that wants to sponsor them is in US, but the original head branch of that charitable organization is in Nigeria. Yeah. But however, the company donates charities to another company around the world. Maybe a sponsor in US now wants to sponsor this country, charitable company in Nigeria. They will have used the financial statement prepared in Nigeria here for their own decision whether to sponsor the charitable organization of Nigeria or not. So in that case, it becomes transnational audit. So these are what we call transactional audit, the meaning of transnational audit in this context. I hope we all understand what we have explained in the case of transnational audit. Please, do we understand, everybody? Hello, do we understand very well? Transnational, it is very, very straightforward. And a company or a charitable organization, a company in Nigeria that want to secure loan in abroad. So the abroad company that we want to borrow loan from, they cannot just give us loan. It happens where a company wants to secure loan from bank, the bank will request for their financial statement, 5-year financial statement. So that financial statement, they will now go through it to see that, oh, if we borrow them money, can they return the money back the time they said they are going to return the money? So that is normal process when you want to get loan from a bank. So it now becomes transnational. Maybe we now want to secure loan from another company in another country. So before those company in another country will give us loan, they will have used our financial statement that is prepared in Nigeria audited and prepared in accordance with regulatory requirements here in Nigeria. So if they use that our financial statement, the auditor's reports, and the regulatory framework that we use to prepare the financial statement here in Nigeria, it becomes transnational audit. So that is what we know. That is the meaning of transnational audit in our sense. No more, no less. Do we understand, everybody? Do we understand, everybody? Okay, so let us quickly go to Transnational Audit Committee. So what are the responsibility of Transnational Audit Committee? So let us go. The Transnational Audit Committee is a committee of IFAC, that is International Federation of Accountants. It represents and meets the need of forums of firms, which are firms that participate in transnational auditing. Specific responsibility of the TAC include: TAC means Transnational Audit Committee. 1. Identifying audit practice issues. Here, when issues suggest changes in audit or assurance standards may be required, recommend to appropriate IFAC standard settings board, that is, issues be reviewed. This is what we are saying, that they identify audit practice issue. So one of their responsibilities is to identify audit practice issue, the issue that governs the audit profession for a particular companies that involved in transnational auditing. So they identify audit practice issue and give recommendation where necessary. Number 2, providing a forum to discuss best practice. So this committee also provide a forum to discuss what best practice in area including quality control, audit practice, independence, and training and development of all the staff to do well in their profession. So that's another responsibility of transnational audit committees to provide a forum to discuss best practice in area of quality management, quality control, audit practice, independence, and what training and development. So number 3, proposing member to IFAC regulatory liaison group. So they also propose members, that is one of their members, they can recommend the members to serve as what regulatory liaison group and identify qualified candidates to serve on IFAC standard settings board. So another responsibility is that they also they also nominate candidates, or one of the members of their group. They also nominate them to serve as regulatory liaison group and also identify what candidates to serve as IFAC standard settings board. So they can recommend one of their members to serve as IFAC standard setting board, to be among the members that are going to set new standards for the accounting or audit profession. So Transnational Audit Committee also provide a member that can serve as IFAC standard setting board. That's another responsibility of Transnational Audit Committee. Lastly, they act as formal conduit for interaction among transnational firms and international regulators. Transnational firms, those are the firms that are involved in transnational audits, and international regulators, they are the regulators of of those international transactions. So they serve as conduits for interaction. They serve as the link, the bridge between the transnational firms and international regulators and financial institutions with regard to audit quality, system of quality control, transparency of international network. So this, among others, the responsibilities of Transnational Audit Committee. And this brings us to the end of this chapter on current issues. Please, any questions generally? I'm sure this chapter is very, very straightforward and easy to comprehend. So on Friday, inshallah, that's where we are going to finish our chapter review for this class, for this diet on what to write. And during the revision period, I will still be there, inshallah, to explain extensively on how to write the normal way that we can use to attempt our question in the exam hall, the best tips to use, and how we are expected to answer each of the question in regards to the what to the scenario given to us. Someone messaged me day before yesterday night that there was a question in July 2019 or so, uh, 2019 question 5, and the same question was repeat in May, July 2020. The same question. So another this thing that will also encourage us. See, after if we are treating pathfinders, after the question, I'm sure you go and check the answer to check your what you have answered. So always read examiner's report. Always read it, because if they will tell you that this question is attempted by about 70%, but the the something is poor, meaning that the about 70 people attended the question, 70% rather attempted the question, but the performance is poor. When you see performance is poor, there is 50% or there's 60 to 70% tendency that that question will be repeated in the next diet or the upper diet. So anyway, you see, just try and read that examiner's report to know that they will tell you that, oh, this question is attempted by 90% and the performance is above average. If the performance is above average, so it means that people actually understand the concept of that question. But if they say the performance is poor, there is tendency that they will repeat the same question in the next diet or the upper diet. So this is where I'm going to. So the person reached out to me on that. The same question repeated, that was set, the same question, the same number that it was in question 5 in 2019. I think maybe November or May. I can't remember. Let me just say one diet. Maybe one of the diets, the question number 5. And the same question was repeated in the following diet. The same number, the question number 5 in May, July. I think it's March, July 2020. So the person now told me that the answer was different. I said, how would they say the same question last diet, and maybe they said the question mid diet, for example. They now still repeat the same question in November diet, which are the same question, the same number. It was number 5 in mid diet, and the same number 5 in nothing changed in the question. But the person now told me that the answer was different. So when I got to the office after my normal work yesterday, and I checked, I was not laughing that the answer was not different. What they used, that they not change the answer in another dimension, but it's the same thing. In fact, one of the answers, maybe 5A, the name 5A, they provided answer for 5A in May diet, for example. So in November diet, that 5A, they now want to go and put it in 5B. So when the person is expecting to see the answer of 5A in the same 5A for November diet, is not seeing the answer. So maybe the answer was, the way they shadowed the answer was like, it's not the same thing that they wrote. But if you read it very well, is the same thing. And later on, where in the answer they provided in that first answer was later repeated again. But the first thing that they used to structure the answer was different in some ways. But if the question is on PFI, the prospective financial information. So if you have this material, the two answer was provided from that exactly the way we have it in the material, the way we explain. That was the way they respond to the answer in the second time they ask the question. But the first time they just analyze it straight forward. So, but I'm just saying this for us to just know that decision time is very, very key for us to attend. And may Almighty God help us. So this is where we are going to stop for today, and we'll continue again on Friday as the last class for our chapter review. So until then, Everybody, please do have a wonderful evening and good night. Have a wonderful evening, everybody. Bye bye. Stop streaming. So please